Welcome to the Three Questions Webcast series. I'm Wayne Baxter, Senior Executive Manager at One Capital Management. At One Capital Management, we develop and implement strategies that strive to allow our clients to grow, protect, and ultimately distribute their wealth. And we do that by offering investment wealth management services. Thank you for taking time to check us out. And if you enjoy this episode of the Three Questions Webcast series, please consider liking this video and subscribing to our YouTube channel. Now, my clients are often referred to as cross-border clients. Now, why is that? Well, it's because they're either U.S. or Canadian residents who invest in U.S. and or Canadian dollar-denominated securities, and it could be stocks, bonds, or ETFs. Our process for advising our clients includes an in-depth discovery and diagnostic analysis of their wealth management goals and objectives. And as one would expect, that analysis will include a review of their real estate financing needs. On this edition of the Three Questions Webcast, we'll be discussing Canadian mortgages from the perspective of Canadians who are looking to review their existing mortgages. On this webcast, we'll be reviewing the three questions Canadians should ask before renewing their mortgage. Joining me from Langley, British Columbia is Peggy Sheppard. Peggy is a senior mortgage broker with Invis, Canada's mortgage experts. Peggy is also, by the way, a certified reverse mortgage specialist. That could be a topic for another episode of the Three Questions Webcast. Hi, Peggy. Great to see you. Great to see you again. Thank you for making time for us. I know your schedule is busy these days, so appreciate you making the time. And I'm sure at some point we're going to have you back to talk about reverse mortgages at some point.
Wise idea. Yes.
And well, definitely something that we'll talk about these days. I want to make a point here before we go any further. Peggy has been a great resource for me and my clients. And I really appreciate the work that you've done with us, and look forward to keeping working with you going forward. Now, the last time we had you on, we had Peggy on one previous time, we reviewed the three questions you should ask about Canadian mortgages if you're a U.S. resident looking to move to Canada. And I would encourage you to visit our YouTube channel and check it out if you haven't already done so. It's a great episode, really educational and informative. Now, this time around, we're going to talk about the Canadian perspective, Canadian living here in Canada, who's looking to renew their mortgages, right? So we're going to think about this from a Canadian looking to review their mortgage in Canada, not from a U.S. perspective. So we're going to get right to the questions. And the first question, I think that's really important way to start, is looking at finances. So the first question is, am I financially prepared to renew my mortgage? And so, Peggy, what I'd like you to do is just sort of address some of the things that they should analyze in making sure they are prepared.
Well, when you're looking at renewing your mortgage, there's so much to take into consideration other than just rates. I mean, the basic fundamentals of what is going to be in your future are so important. For instance, things like, are you making a big purchase in the future? Is there any debts that need consolidated? And is it a possibility of selling during the term of your mortgage, perhaps downsizing, upsizing, or even major renovations? If you take that into consideration at the time of renewal, you have the biggest opportunity to really get it right and plan. And that's the biggest thing that people often forget to do, is really look at the whole thing. They're so focused on the immediate, oh, is this the best rate? Which hopefully it is. But if it isn't, there's so much more that you really should be taking advantage of for your financial future.
Now, one of the things unique about Canada is the fact that there is a qualification that's a little different from what we see in the U.S., and that is that when you're looking to renegotiate, and I believe it's also if you're a first-time buyer or getting a mortgage, you have to qualify at a rate that's 2% higher than the actual rate. Can you sort of explain how that works?
That's correct. The qualifying criteria is that you must qualify no matter what your base rate is. This goes for fixed or variable terms at 2% higher. And the reason this was implemented was because the rates were so low and people were really getting in over their heads. They were expecting that that what was normal at the time, like a 1.76% interest rate, was never going to change. And historically, that's not the case. So what they were trying to do, albeit I wasn't happy at the time, it has come to fruition in that many people have already hit that target market when they're coming to for renewal, or if they're a variable rate. And that's caused them to be able to afford their mortgage now and in the future. And that's really what it's determining. So you are qualifying 2% higher. and that would be on your fixed rate, or if it's variable, it's the variable rate at the time plus 2%.
Well, it leads me to another question. I'm sure we're going to cover a few, but just for the for someone who has an existing mortgage and their situation has changed, and for whatever reason they don't meet that 2% criteria. Just let's make up a hypothetical case where, for whatever reason, their debt service ratio changes. What happens? Are they able to get a mortgage, or what are the stipulations?
Well, in a case like that, they can certainly look at renewing with their existing lender. They do not have to requalify at the higher rate at that point, and that can be really useful. If they don't qualify, the other thing is that we can look at extending the ratio, the amortization back, and that's something that works really well with that. If people have been paying an accelerated biweekly or something like that that's accelerated, that was a choice the clients made. It's not a requirement, it's a choice. So the mortgage was actually registered, whatever that term was, say 25-year amortization or whatever. And they have a right to say, okay, what would it have been had I not accelerated? And so we can sometimes spread those payments back to what it normally would be. It could be 2.5 years. Well, that might make it affordable versus not affordable, and qualifying versus not qualifying. But certainly if there's any issues, renewing with your existing lender is a great plan.
So the good news is they're not handcuffed and not being forced for any reason to put their house back on the market.
No, that doesn't happen. And the banks really do not want to be homeowners. So they usually work with the clients, but no problem at all. They can certainly stay as long as they've been making their payments, maintaining their criteria, and maintaining their home and their credit bureau, they're fine.
All right, that's great to know. So the second question we're going to address today is, and again, this coming from the homeowner, is what interest rate is being offered by my current lender? So again, this is in the context of looking to renew a mortgage.
Mm-hmm. And you want to know what your current lender is offering, obviously, and you also want to know what else is on the market, because if it's comparable, is it worth switching? And that's the biggest thing. Yes, you can transfer basically at no cost from your one lender to another lender, as long as you're not changing the amounts or the term of the mortgage. Meaning if it's 25-year amortization, you're moving out of 25-year amortization, you're not taking any extra funds. You can move to another lender, and that's not a problem. But is it worthwhile? Because you do have to fully qualify, just like as if you're originally taking that mortgage. So that, that's something you want to make sure as well, to make sure it's worthwhile.
So for the folks here in the United States, one of the unique things about Canadian mortgages, it's not a fixed rule of thumb, but generally speaking, many Canadian mortgages have to renew. They don't have to change the duration, but they renew every 5 years. Or in the United States, you can lock in a 30-year mortgage, and especially here a couple of years ago, people were locking in at 2.5%. And the likelihood is they're not going to be looking to renew that mortgage anytime soon.
No, the thing that they would run into is if they refinance or sold. Then no matter Canadian or US, the same would be applied. You'd have to requalify and do that. Refinancing, same thing. You break your current one.
Right. But in Canada, after 5 years, you basically have to almost like reset or reestablish the rate of the mortgage.
Yeah. We have them as long as 7 and 10 years, but not that popular.
No, well, what I've noticed with those 7 and 10 year rates is they typically are higher as a general rule than the existing mortgage. So most people wouldn't lock in.
Typically not.
Usually. Okay, so let's get to question number 3. Besides my financial preparedness and the mortgage rate being quoted, what are other terms and conditions I should be aware of? Well,
in the case of going back to what are you going to do in the future, you want to look for things that that lender is offering. For instance, prepayment privileges. How much are they? When can you make them? Can the terms of their payments be made? For instance, you might want to be making biweekly payments when you're working and monthly payments when you're retiring. So you want to be able to maybe potentially change those mid-course. Some of the other things you want to make sure is if you're planning on moving, is this mortgage portable? Is it something that can grow with you or change with you to another property? Say if you're downsizing or move for work or whatever. And a lot of good mortgages really do offer that, and people aren't aware of it. And it avoids all the penalties.
Yeah, for actually, if you want to get out of the mortgage. Another term I keep hearing about is something called assumability. Could you give us a quick explanation of what assumability is versus portability?
Yeah, so assumability was big in the 1980s in Canada. It's not as popular now. And what it means is if you had a really good low rate, which of course is happening now, you might have a rate of like 2%, for instance, fixed for so many years. The people that buying your house can actually try and qualify to take over that mortgage. They do have to qualify, but they could actually assume that mortgage. Now, this can be really good if you're trying to sell your house. But the problem with if the people taking over your property don't maintain that mortgage properly, the threads are not really truly ever cut. So can that bank come back on you? They will try. And it depends on whether or not that bank did their due diligence at the time to make sure that it was affordable. So this is usually not something that happens. Assumability is not that popular only because of that, because it really can put a strain on the people that are actually selling. It's only really a benefit for the people buying. So it's not that popular. Portability is far better in most cases than assumability.
Definitely for the seller.
Yeah.
That's for sure.
Yeah. They're not getting they're avoiding a penalty, but they'd be better to port it.
So one additional question before we wrap up this edition of the webcast, I wanted to just run by you, and really timing. Usually, we don't recommend market timing, when it comes to investing, but when it comes to the mortgage planning process, when should I start looking at renewing? Like how far in advance? Like I'm going to pull a rapid, just say, I know I'm going to be renewing my mortgage at the end of June. I'm just pulling a date out of my hat here.
Yeah. Typically, a good rule of thumb is 6 months in advance you start thinking about it, and 3 months in advance you should be really looking at locking in. The benefit of that is you know what you've got. And the other benefit is if the case you say, yes, okay, we know what we want to do. We know what's coming up. We want to make this change or this new term or whatever. In between when you say yes and when the mortgage actually renews, if the rate goes down, you can actually go back to that lender and say, I would like to have my rate readjusted. And often they will do that because they don't want to lose the business either. So locking in a little bit early is not a bad thing. And especially if you're timing the market. If you're trying to do that, for instance, in the spring, a lot of the banks and trust companies and credit unions and all the different lenders are really trying to get you to come to them for business. So in a busy spring market, even though your mortgage doesn't renew till later, you might be better off taking some of the perks that are offered in the spring.
And I would assume that if rates are going downward, you can take advantage of a lower rate in the future as well, in terms if you haven't closed.
That's correct, yes. And you definitely want to do that. And it's something that you want to be working and watchful of during that time. Particularly, you already know your lender at that point. So it's really just watching what they have on the market. And if you're working with a broker, they'll help you through that process as well.
Now, for someone's looking for financing assistance, I can't think about a better resource than you here, I must admit. Now, what parts of Canada can you cover, and how? And first of all, what parts of Canada they cover, and then how can they reach you?
Okay, so I'm lucky enough to be licensed in the provinces of BC, Alberta, and Ontario. So I'm fully active in all three provinces on a regular basis, and I have access to the other provinces, all except Quebec. Not that I can't do Quebec; they have different rules and regulations there. So I would pass you off to another person who I do have connections with. But otherwise across Canada. But my main three provinces directly licensed are the three major ones.
That's perfect to know. And again, what is the best way for people to contact you? Is it by phone, by email? What would you prefer?
Both are great. I mean, I always appreciate a phone call because then I can actually talk to the person immediately and answer some of their quick questions. And then we can always follow up with emails, correspondence back and forth, following up with what's required to go through the process. But a phone call is always welcome. But if it's easier for you to drop an email, that's absolutely fine too. Let me know where you saw it and I'll be happy to help no matter what.
Perfect. Peggy, you've been a great guest today. I really appreciate you. You've been a great resource. I look forward to continue working with you going forward.
Thanks. It's a real pleasure.
Our guest today was Peggy Sheppard. She's a senior mortgage broker with Invis, Canada's mortgage expert. Great guest she was. Thank you, Peggy.
You're welcome. Bye.
I look forward to bringing you the 3 Questions webcast, and I hope you find them educational and informative. Please consider liking this video and subscribing to our YouTube channel. And if you receive a notification of when our latest webcast has been posted, please click on the notifications bell. Lastly, to schedule an online Zoom consultation with me to discuss your wealth management needs, please click on the link in the description box below, www.onecapital.com/meet with Wayne. Thank you and see you soon.